This is the Wealth Standard Radio, your gold standard in everything financial.
Hey everyone, good morning. This is Patrick Donohoe. Welcome to the Wealth Standard Radio. This is episode 165. And I am joined by a really good friend of mine, Eric McGuire. Eric, let me hear that voice.
I'm glad to be here.
Yeah, I love that deep, manly voice. Okay, we're going to talk about something that we if you don't have a Red Bull in front of you or coffee or something, you probably need to get some, because it might be a topic that may not be too intriguing to you, but by the time we're done, you're going to definitely want to learn more about it, and that is the Federal Reserve and what's going on this week with Janet Yellen. I don't know if she's a Mrs. or a Miss. Probably a Mrs. Who knows? Anyway, let's before we get to that, let's talk about the Cashflow Wealth Summit, mini summit that is on real estate investing. So for those of you who are longtime listeners, you know that we have done the Cashflow Wealth Summit, our annual summit, for a couple years now, but we have decided, based on some demand from listeners, to do a mini one solely focused on real estate investment. And one of the side reasons why I want to do this is because I look at what's going on in the real estate market, and I see just so many signals of things just not making sense.
Yep.
And it's anywhere from analyzing properties that clients own, where you run a pro forma and it's like a 1 or 2% net return. You look at just the lack of kind of common sense when buying. Yep. And so it's going to be a good summit, because Jason Hartman's going to be on there. We're going to kind of go through his experience through like 2006, 2007, what signs he saw, and then what happened during 2008 and 2009 with a lot of the properties he owned. And then I'll kind of chime in with him. We're going to do kind of a joint presentation there. But we're going to talk about what are some similarities between those times and today.
Yeah.
So that's going to be a good presentation. Plus we have Tom Wheelwright. He has a really, really cool. Actually, I don't even think I can announce it yet, but he has something cool he's going to announce in the next couple weeks. But we're going to be talking about that. So again, the summit is end of October. You can go to cashflowwealthsummit.com, and there you can register for free, and we'll keep in touch with you, giving you announcements, giving you heads up on times and the other speakers and so forth. So it's going to be a good time.
Yeah, that's awesome. I've had a ton of clients ask, the value they've gotten from the previous ones we've done, would we do them more often? So I think there's probably a lot of people going to be really excited for this.
Yeah, and it's one of those things where it's not incredibly easy to put those things together, but it's we're definitely going to try to do them more frequently. So this one should be good. So again, cashflowwealthsummit.com. You can register there, and I believe you also can access the previous 2 years of summit videos. So if you have not heard about it before, this is the first time you're listening, definitely go there. It's a great resource. Also, our website, paradigmlife.net, we have some good resources there. We've made some updates recently, so make sure you go check that out. We have a free e-learning program called Infinite 101 that you can register for. Okay, so let's talk about what's going on this week with the Federal Reserve. Now, before you turn off your podcast, you got to realize that everybody is affected by this. Okay, whether you have money in the market, money in real estate, whether you're employed by a farmer, employed by IBM, or doesn't matter. Everybody, I think, this is one of those things that happens, and the monetary policy of the United States literally affects everything.
Yeah,
and
absolutely.
If individuals, I think, knew more of just the ripple effect associated with these decisions, they would pay more attention.
Yeah.
So we're going to try to do our best today to really talk about what Janet Yellen is going to be doing this week as a result of the FOMC, Federal Open Market Commission, and really look at why that decision is important. Not just the decision itself, but oftentimes the language.
Yeah. And
I think that's going to be, it's going to be extremely vital, really, for what's going to happen with the election, with the end of President Obama's two terms. So it's going to be, it's going to be awesome. And I think that it's really going to tell us what's going to happen. And the reason why I say it's going to be awesome, because again, it just kind of illustrates what we've been talking about for years anyway. And you and I are going to go through and talk about some practical things that you could do to prepare for this. And so I think you're going to get a kick out of it. So anything you want to chime in, anything you want to
I just add that,
learn through the conversation?
Before we even started recording, we were having the discussion that, it's a difficult concept to understand. And then I think that experts try to make it even more difficult because that's their job too.
Yep.
And so we're going to try to go the opposite approach and keep it very simple, because it's such an important concept to understand that if you're missing it and don't take the time to learn it, it affects, just like you mentioned, everything in your life.
Yep.
And so we're going to try to break it down into something that you can know. What do you push for that's good? What do you say bad? When you're with your friends, you'll know the decisions, what to talk about.
Yeah. Well,
on your terms, we're not trying to write a scholarly paper about it. We're trying to educate you to be able to be informative.
And I think that's what's fascinating about our society today is you look at just how important context is, because we're growing so quickly, we're evolving so quickly. And I've told a story a couple of weeks ago when I was at an event and I had a really cool conversation with these two people that worked for Google. And we were talking about, just some of the innovation. There's some things they can't talk about, but we got to this point where they were trying to explain something to me and I had no idea what they were talking about. I was like, well, what's that? And he's like, well, it's this. I'm like, well, what's that?
Yeah.
And so it's really, the context is so important, because if you do start talking at a level where the context isn't there, nobody's going to get anything out of it. So we're going to try to keep it at the layperson level.
I mean, you sent some articles over that I printed out, and there's a couple paragraphs in them. I read them twice just to see, what are they even trying to say there? Because they run on their sentences. They use a bunch of words that we don't commonly use. Yep. And you realize that, they're talking over people where that's not always productive.
Cool. Yeah. Well, let's get into it. So the meeting that's going to take place this week. So why do they have these meetings, right? So they have, there's different there's different governors that are on top of different, Federal Reserve banks throughout the country. And, they're in Jackson Hole. They were in Jackson Hole and they met there and really discussing, okay, what's going on in not just the U.S. economy, but the world economy, okay? Because everything right now is more connected than it has ever been. And so you look at, really the Brexit idea. I'm sure that was a topic of conversation. It was, looking at trade imbalances, looking at, the amount of debt the United States has, looking at unemployment and employment, looking at wages. I mean, they look at all sorts of different factors. And what is their objective? What are they trying to do?
They're, basically trying to establish what should be the federal interest rate that they charge.
Yep. And so why, so the interest rate that's being set, like what does that have to do with anything? And I think that's probably what people are always asking. It's like, okay, well, there's this interest rate, but what does that mean? Right. Yeah. So you look at, the interest rate that they're talking about is the discount rates, really the interest rate that's basically the Federal Reserve can lend to banks.
Yeah.
But it's more than that, because it's the most significant signal that exists as far as not just, like I said before, not just the U.S. economy, but the world economy.
Yep.
Now, what is the Fed's policy? So the Fed, they're trying to, and again, this wasn't their intended purpose way back in 100 plus years ago, right? Their intended purpose was really to be the lender of last resort. But they've become this body that is essentially pulling levers, putting money here, putting money there, lending money here, this interest rate, that interest rate, and they're trying to create stimulus so that the economy grows. Yeah. Okay. But what's wrong? What's wrong with that? Why is that? Because there's obviously been lots of unintended consequences, but why do they want to do that? Why do they think they can control that with an interest rate?
Yeah. And the issue, what you're kind of talking about, is the intent, or what they said the intent was they would look at it, and if they feel like the economy is slowing down, they would lower an interest rate that they loan money out to banks to, which would result in the banks lowering the rate that they loan it to us. Yep. And that would incentivize us to take loans and buy things, hopefully stimulating the economy. Yep. And it arguably worked or didn't work for so long. Now the problem is that's happened for so long that we've artificially gotten that so low, it can't really go lower. And now their fear is if they raise it higher, it will hurt an already slow economy. Yeah,
so let's talk about those couple things. Great points. So you look at really an interest rate, and it's to create a certain behavior. Yep. Right, because they're wanting to do what's called they create aggregate demand. And aggregate demand, it's a fancy way of saying they want people to buy stuff. Yeah. Right. They want them to go on vacation. They want them to invest in machinery. They want them to they want them to buy a car. They want them to go to school. They want them because basically that there creates demand for things, and that's how money kind of flows through the economy.
And you see it in advertising all the time. I mean, especially the mortgage market. Yeah. You'll see. I mean, every flyer, every billboard. I mean, just watch on the way home from work today or wherever you drive, you'll see billboards, rates historically low, take advantage of it now, refinance your house. I mean, they're saying those words trying to get you to borrow money.
Yeah, and looking at, again, the reason to have high interest rates, right, which will curb inflation, okay, is because they don't want people to spend. They're spending too much, and they want them to put money in the bank. But here's the conundrum, right, is their policy working? Are people out there spending tons of money?
No.
Right? right? And so that's the irony, is that their narrative hasn't changed.
Yeah.
Okay, but yet the actual behavior has.
Yeah.
And so it's interesting that we've talked about this article before, but and it was done by Robert Wenzel, who runs the Economic Policy Journal. This was years ago, but he had this interaction with the Federal Reserve, asking them in a nutshell, like if human behavior is irrational, right?
Yeah.
We do all sorts of random, crazy, stupid things, but yet you're trying to make decisions based on a certain human behavior.
Yeah.
What if it's different? What are you going to do? Are you going to make changes? And they haven't. And that's why they've continued to push the agenda. And really, in the end, who's winning?
Yeah.
Right. And that's another conversation for a different episode.
I love that you talk about, though, like the human behavior part, because assuming the best of the Federal Reserve, which we can debate that as well, but even if their intentions were pure, it's not going to work.
Yeah.
But then when you bring in, corruption or any other, just what they can do with it, it's so private, and we don't really know what they do on the back end.
No. And
their meetings aren't public. We have no idea. There's no audit of them.
Yep.
So even on the best scenario, though, if we knew all that information, human behavior cannot be predicted.
No.
And so either way you want to slice it, there's a danger there.
And I think the thing that's really kicking them right now, and this is, I brought this topic up before, but it's really, you have this other kind of societal narrative that is trying to push prices down.
Yeah.
Right? It's trying to make healthcare less expensive. It's trying to make a computer technology. It's trying to make even food less and less expensive. And that's the nature of technology. It's very
capitalism.
Deflationary. It's the nature of capitalism, right?
Yeah.
It's to get more with less.
If I can make something cheaper than you do and provide it for there's value, and I should succeed at that.
Yeah. But yet at the same time, that is the opposite
of
what they're trying to do, because they want 2 to 3% growth over and over and over, because it's predictable. It helps people make decisions.
Yeah.
Right. And they want, if I make a decision now, I want to, make sure that, the price of this or that is that way in the future. Right. And so it's really looking at what they're trying to do. And I guess it's logical, but the signs are all around them that it's not working.
Yeah.
Right. And they've tried everything. They've tried QEs, and they try to buy bonds. I mean, right now, I can't remember the percentage, but it's like the bond market is like, I think the U.S. bond market is like 38 trillion. I mean, it's huge. It's just a massive, massive market, and nobody's buying long-term.
No.
Long-term, right? The government or the Federal Reserve is the one that's buying it all out of nothing. Yep. So it's just fascinating to me, just like those signals. If people really understood what it meant, right? I think people would be pretty upset. But I think again, because of really the lack of context, the lack of understanding, they just don't know. They don't know what it is or what to do.
And I think one thing we kind of talked about how it may affect them for getting a car loan or a home loan, but let's talk maybe about small business. And one of the articles you sent talked about how in the U.S. there's 26 million registered businesses, but really only about 6 million active. And then it said that of those 6 million, 80% of them have fewer than 5 employees. So they're small business. So 4.8 million small businesses in the U.S.
Yep.
And the article talked about how they're sitting on money. And so it's businesses that say we're optimistic about what the product that we provide. We're optimistic that we could sell it, but we're not going to put our neck out there because we have no idea what's happening with the Fed or with that.
Well, that's again one of these unintended consequences, right? Is you push all sorts of money into the economy and give people credit, and you give them money in the bank, but yet when it comes to making a decision, which is to grow the economy, which means they invest, right, or spend, they're only going to do it if they think they're going to turn a profit. And if the economy is a wreck and they don't know what the future is going to hold, I mean, right now, even with our business, it's like they're messing with what's considered a full-time employee and what's not. How do you give benefits here or there? So there's so much like uncertainty that if you make a decision now, if everything was the same, then there wouldn't, you would be able to make an educated guess as if you're going, relative to making a profit, right? Being profitable.
So your point being is that they're not nervous that they can make a profit because of their business. They're nervous because of the external factors of the government that they don't have control over.
Exactly. Right.
And
so it's not just one specific thing. It's multiple things. That uncertainty basically causes people to do nothing.
Yeah. And if those businesses hired 1 or 2 people, that's 5 to 10 million jobs created that they are willing to do if they had the certainty of this.
Yeah, so let's go down that path a little bit, because that's one of the topics I wanted to discuss. Because as I said in the beginning, most people, they look at, okay, well, it's the Federal Reserve and it's banking and it's interest rates, and it's like, well, I don't have a credit card, or my home's paid off, or I have a low interest rate on my home, or I don't have any debt, or XYZ, ABC, whatever it is. But looking at, again, the most significant signal of the economy, and what that does, it affects everybody.
Yes.
Regardless of where you have your money, regardless of your profession, regardless of your employment, it will affect you.
Yeah.
Okay, it'll affect where you go out to eat. It'll affect where you get your groceries. It'll affect the car that you buy, the gasoline. It affects everything.
Yeah.
Right. And so I think this is just an example where a small business, the average small business employs 5 people. You said, okay, well, those 5 people are probably not paying attention to what Janet Yellen is going to say. Today and tomorrow, right? They're gonna look at, well, do I have a paycheck? Okay, or am I putting money in my 401k or in the market, right? They look at that, but they don't see the correlation.
Yeah.
But looking at the reason why they have a job, it's because their business owner can be profitable, right? But what could monetary policy cause for the business owner, or what other government regulation could cause for the business owner? It could say, okay, now you have to, this is just an arbitrary comment, but you can say, well, now you have to provide full benefits, and you have to provide a pension, you have to provide all these things to the 5 employees, and it makes the company unprofitable. What's going to happen? Companies go out of business, and now the individual thinks, well, it was the Federal Reserve's, or they think it was an employer's fault. But in the end, it was really caused by the initiative set by the Federal Reserve. So anyway, there's so many different layers of it, but in pretty much every single circumstance, your community, society in general, the world internationally is affected by this decision and what the Federal Reserve is actually trying to do, because they're the ones, again, they're throwing stones in the water, and those ripple effects are rippling all over the place. So it's just an interesting dynamic that even with a small business, it hits so close to home. Yeah. All right. So what else? So maybe talk about. Let's talk about real estate, right? What does this do? Well, maybe real estate and the student loan crisis. Why is it important, for students that are in school, that have debt, that are paying tuitions? Why is it important for them? What do you think? What do you think about that?
I mean, just any loan market. So we've already talked about business loans, personal loans, and then student loans, and what was the other one you mentioned? Student loans and real estate. And
real estate, yep.
I mean, that's the price of going to college is your student loan. Yeah. And so if they mess with that, and that's where you go to college, and usually they'll give you some benefit as you're in school, but then when you graduate, then it changes. Mm-hmm. And that disruption is what causes people to default. Yeah.
Well, look at the worst time to go to school in the last couple of decades. Okay. It was like 2005. Yeah. Worst time, right? Because you go in, the economy's amazing. Okay. Yeah. You come out, and the economy is the worst that it's been since the Great Depression, right? Yeah. And so you really look at, again, student loans. That's one thing, is the market that exists. Okay, is it basically is how you're going to pay back your student loans, but you don't know what that is 4 years down the road. Yeah. Right. Other thing is you look at really the student loan debacle, and that's a topic for another day, and we've discussed it before. Yep. Right. But the student loan bubble it makes college, it creates a price for college. Yeah. Okay, because you look at the bonds that are created for different projects that universities put on, like the University of Utah, right? Recently did this huge bond, right, for a new law building, right? And they do a bond for a new stadium. I'm not talking about the U, but just in general. Yeah. They do a bond for a new athletic field or a student center or whatever, right? Those bonds all have a coupon rate. They all have an interest rate associated with it, right? And they're going to raise more money if the interest rate is lower. If it's higher, then they're not. Right. And then you look at, again, the economy and what fuels universities, it's revenue. Yeah. Right. And if there's less people going to school, they have less revenue. Therefore, they're not going to be able to pay their bond back. Yeah. So again, everything has correlation.
And often with those cheap bond rates, they may do things that economically don't make sense. So you say, we really don't need a new building or new stadium or new something, but money's cheap, so we'll go do it. And then that bond is a long term. They're not going to pay it off in 5 years. Yep. So they make a decision now, and then they realize, 10, 15, 20 years. Yep. You see this with like rec centers in in cities.
No,
they'll build a huge rec center and it's nice and looks really good the first couple of years, but then it gets run down, and when it's 10, 15 years old, it looks trashy. Yep. But they still owe for another 15 years on it.
Yep. No, there's a documentary I saw called The Ivory Tower, and it talks a lot about the higher education in general.
Yeah.
And there was a university that was basically the university is funded by a trust that owns the real estate underneath the Empire State Building. And the objective of the university was to be funded by the lease income with this insanely valuable land. Okay, but the university went out and got this like $20 million loan to build this new like center, and started to get to the point where it was not profitable, and they started to incorporate tuition. So it was a free university, absolutely free, right? So anyway, that's another subject. But again, this is what happens, right? When you have low interest rates, you have what's called malinvestment or malspending, right? And that is, it's basically spending that is happening that shouldn't happen, but because of certain factors, it creates justification for the spending. So anyway, all of these issues affect people to one degree or another. So looking at what she is going to say, let's maybe get into some conjecture about what's going to happen, just given where we're at with the presidential cycle, with the economy and so forth. What do you? What's your prediction?
I don't see her changing anything. Do you?
I don't either. No.
Yeah, I mean, because what you just said, disruption. So the last thing they want to do is cause something that's going to mess up the economy even further.
Nope. Yeah. And it's going to be interesting because there's so much press about it now, and they've created this expectation that because they dropped interest rates so low, they're going to try to get them back up to 2%, right? And they've only made one hike in the last, I think, like 5-6 years, and it's by a quarter percent. Looking at how the market's priced right now, it basically says that there's a 20% chance that they're going to increase interest rates.
Yeah.
Okay. So what's going to happen to the market if interest rates do go up? Market's going to dive. They say probably anywhere from 30% ish is the top. So anyway, it's one of those things where it's amazing how they price those decisions just based on people speculating on commentary from Jackson Hole or commentary that has been made previously. But
that's a good point though. I think if I could speak to what the population of the U.S. 350 million. If I could speak to every person in the U.S. at once, that would probably be the message I would deliver is, let's not look short term. I think we make all these like 6-month decisions versus 10 year decisions. Mm-hmm. So we always put it off, and that's why we're in the trouble we're in.
Yep.
Where raising these things may cause a short-term disruption, but long-term it would be beneficial.
Yeah.
And so, we've but the reason they don't do it is because if they raise it, the markets get crazy, then we're calling our senators and we're yelling at them, and then they
put pressure on the Fed,
and it goes all
and
through.
It goes all the way through.
And so the pressure we put, and that's why I said I wish I could talk to every single person, because it takes us as a collective body expressing, saying, do what's right for the long term, not for the next 3 months.
Yep. And that's the nature of just the markets in general. Everything is priced on a short-term cycle, and it makes it impossible for companies to make long-term decisions.
Yeah.
But anyway, that's another topic. The idea though is there's so much that's going to come from this, but I think right now the writing's on the wall, which is they don't want to create disruption associated with the election.
Yeah.
Okay. With the end of Obama's term, you don't want to go out with a market crash.
Yeah. Because obviously that's the voice in her ear.
Yep. Oh, absolutely.
So she's not going to do anything that's going to hurt.
As much as we want to say that they're independent, as much as they say they're independent,
they're not.
They're not.
Yeah.
So
it would be the same thing, when Bush is leaving. I mean, whatever offices, whatever party's holding office, it's always going to go in favor of that.
Okay. So looking at what's going to happen, let's also talk about maybe just some things to understand based on it happening now, but also there's another meeting in December, and after that we're going to know who the new president's going to be. But looking at just these meetings and the nature of our U.S. monetary policy, what should people do? And I know that we've had that conversation, and again, I think it's going to be different specifically for everyone, but generally, in my opinion, it's the same thing. So let's talk through that, because looking at it, this is hopefully by now you guys see that really the Federal Reserve is trying to create just these unrealistic things in the economy, unrealistic growth, unrealistic behavior. And we've seen it for years, and nothing that they're doing is working. They've tried QE1 and QE2 and QE3 and Operation Twist and all of these different things to try to incite the same behavior. but it hasn't worked.
Yeah.
Right, because they're looking at the wrong behavior.
Yeah.
So how it's going to get priced out, there has to be some chaos. Okay, but instead of looking at how, when, I think we've talked about why, but how and when, it's hard. But I think everybody generally can start to prepare in certain ways depending on what occurs in the economy in general.
Yeah. And I don't know if this is exactly kind of where you want to take it, but I think it's a good point. We can come back if not. But with what we teach here with the perpetual wealth strategy, does that decision have any impact on that strategy for our clients?
No.
That's the cool part.
Yeah.
Is what we teach is blanketed away from that. Markets could go crazy. And they could do that in public, there's so much peace of mind for me educating my clients and getting them in a spot that they don't have to sit up, wondering what's going to happen tomorrow.
Mm-hmm. No, but I actually, let me retract my statement. So I would say that it does affect it, okay? Because if you go back to like the early 80s in the insurance industry, people, when interest rates spiked to like 10, 15%, right? People would, cancel policies and put it into a CD or a savings account. But I think that was a time period where there wasn't as much communication as there is now. So it'll be different. At the same time, insurance companies are affected, right? Because, looking at, markets like the bond market, I mean, they buy a lot of corporate bonds.
I guess
and so I think, but as far as like with the actual products that are set up, they're not. But I think it's still important because a lot of our clients have these questions. Yeah. Right. But I think insurance companies, if you look at, as an example, 2008, 2009, they made some of the best money in decades. Okay. Because they thrived off of being able to have liquidity and make investments. Okay, when people were being irrational, when they were selling, when they really should be buying. Yeah. And that's where insurance companies cleaned up. They cleaned up on real estate. They cleaned up on some incredible, bond yields. Yeah. But it was all because there was some market correction. So I would say that there's kind of like this inverse, right, behavior of an insurance company.
No, it's a good point.
Like a mutual fund or another investment fund or a real estate fund. I think there's some opposite behavior there. So really, if there is chaos, that's all that is good for the insurance company. But in the end,
they're not going to wake up and their policy have a different value than they did.
No, and that's what your point was, which is you're not going to wake up one morning and suddenly your policy is obsolete. Right, or your cash value is obsolete, your dividends are obsolete. No, it's just the companies themselves that guarantee them. Okay, there's some changes there, but they've had those changes for 150 years. They know what to do.
And hopefully, our clients too, like you mentioned with the 80s, if we get into those same rate environments, let's say 15 years down the road, they've had the experience. That's what we teach. It's not a product. It's a lifestyle. It's a way of being, and they can see the certainty now. So when they get in there, dividends will also be better than they are now, which was good news. But they won't have that carrot of, if I jump ship and go over there, they'll have the long perspective of this works in each environment and it works really well.
And where you were going with it is, again, this is kind of the general things that we believe and we do and we've talked about forever, which is, when you do have money in speculative type of investments in the market, okay, or even in real estate to an extent, okay, you are subject to the winds of the economy. Yeah. Okay. And right now there's trillions, okay, in mutual funds. There's trillions in the market that's trading every day. And all of it's affected by stuff like this. Okay? Or black swans, right, that really say, wow, it didn't work, unload. Right. And those events happen very quickly. I mean, if you look at 2008, all of it happened in like a year. It was crazy just how quickly it went down. But looking at our purpose, the general feeling that we've always come to is there's a few assets that you have that will not fail. Okay. The first one is you. Okay. And that is, basically you're the one that creates money. You're a printing press. Yeah. Okay. And it doesn't matter if it doesn't matter what it's called. It could be called a dollar. It could be called a yen or whatever. It doesn't matter. Okay. Money is exchanged for value. If you figure out how to create value, right, then you, right, are always, that is an asset that will not lose. Yeah. Okay. The second thing is, as far as, the U.S. is concerned, I mean, you have what we teach, which are these insurance policies, which are they 100% bulletproof? I don't think anything is. No. But if you look at, look at history, nothing's ever failed. Yeah. So that's another, keeping liquidity there. And as you said,
if it failed, there'd be a lot of things that failed first.
That's true. And if you combine those first two assets, okay, that is basically when the chaos ensues. You have the wherewithal, your anxiety level is less, and you can operate how the insurance companies operate, which is they look at those times as huge opportunities.
Because you have capital.
Exactly. And right now, I mean, there's a lot of pressure on an outcome that is going to cause insanely irrational behavior. And I think that is something a lot of people are, not a lot, some people are anticipating, but others are completely oblivious to. And again, it's because they see this arm's length between who they are, what they do, their employment, their community, and monetary policy. There's this gap or void there, and because of the lack of knowledge, they don't understand that when they they wake up one morning and they don't have a job, or they wake up one morning and their house is now half the value, or they wake up one morning and their pension that they were going to rely on for the rest of their life is bankrupt, or Social Security, they said they were going to promise, $1,000 a month, but now it's $500 a month. Yeah. It's one of those things where, people wake up and don't realize that, some of the things that they could have been aware of now, right, would have allowed them to prepare for those times, but yet they don't learn until it's too late.
And they blame the source closest to them. They blame their employer. They blame... Yeah, and they don't blame the person on top of their employer that put the pressure on that caused the
event. For sure,
and
it's a waterfall effect, dude. It's like, okay, you have the waterfall, which is it spills from one, to the next little pool, then that pool to the next pool, and that to... But by the time it reaches, the person at the bottom, which is typically the American public, who ends up, fitting the bill for everything, okay, they can't see the first waterfall. All they can see is, like you said, the one that's closest to them.
Plus, it's not immediate. It's not like if she did something crazy drastic and it caused your employer to go out of business in 2 years, because they're not going to go out of business the next day. So you're not going to see it, but you're going to realize, the employers are going to try to stay in business as long as possible. But eventually it may weed them out. And yeah.
And again, it's one of those, I look at it, we live in an amazing time because we have access to so much information, right? And it's easy to go and learn about these things. And I think they affect everybody. Everyone should know kind of the basic objective of U.S. monetary policy, which in a sense is kind of like the world policy. And then you go and you look at the different sides of the coin, okay, seeing one perspective, right? Which could be like the Mises Institute or FEE, but then you can also see like the other side, which is Paul Krugman, right, who's a very aggregate demand type of guy, and so you can start to see both and see which one's right, which one's wrong, and come to your own conclusion. Okay, but then hopefully that knowledge and education will allow you to make the best decisions possible. And these days, like I said, there's so much information out there, but yet, really understanding the consequences associated with not knowing, I would say, is very important, because I don't know if anyone's going to wake up one morning and say, "Oh, maybe I should go study the Federal Reserve." There has to be kind of like a motivation to do it.
It's true.
And the motivation of really something is brewing right now. Something is brewing in the economy, brewing in society on so many different fronts, right? Whether it's technology, whether it's monetary policy, whether it's international relations. Okay, look at Brexit. Look at Great Britain removing themselves from European Union. You look at other countries that may do that. You look at what Russia's doing. There's so much interaction, so much communication between all of these different countries and societies and cultures that it's fascinating to witness that. But I think that the future holds anything but consistency. I think the future is going to be really interesting because of how technology is evolving, because of how societies are evolving. And that's where it's like those are all the reasons to listen to those first two things we said about assets. You're your greatest asset. The next greatest asset is something that you can't lose. Okay, and I think that if people don't wake up to that, it's going to be they're going to learn the lesson. It's just going to be a little bit too late.
And like you said, with the added knowledge, the term insurance companies use is human life value. The more you know, the more you're worth. And so if you study this, like you said, no one wakes up to study it, but if you do study it, for one, it's good for you. It's good for society. You're going to be less susceptible to people misleading you or misguiding you. But also, like you said, with cleaning up in an opportunity, when you see what the Fed does, you'll know what impact will that have on your portfolio. What decisions could you make? How can you take advantage of that? How can you not let fear make your decision, but information make that decision? And there's a lot of opportunity for you as well, just monetarily, to understand it.
One of the things you said I think was interesting, which is once it happens, okay, and you studied both sides, you're gonna know which one had some things right, which one had some things wrong. Okay, and I would say the people that really got it, those are ones you can start to listen to and see what they're doing and what else they're saying, right? Because that's another signal. But looking at what goes on behind the the curtain of Jackson Hole, and look at what the bankers from the world are saying, the politicians of the world are saying, I don't know. I mean, you can speculate on it. You can look at what the decision that's going to be made, but I think right now the markets are pricing it, so it looks like there's not going to be a hike. But the reason behind it, right, is really not necessarily pressure of the strategy not working, but it's not to cause disruption and chaos during the time period that we're at with elections and a new presidential cycle. So it'll be interesting, man. I mean, it's just it's one of those things where there's always opportunity and there's always good that really comes from chaos and disruption. But right now, I just think that it's we're the black swan. I don't think it has to be that big.
No, I agree.
All right, do you have any final comments before we cut this one and hopefully?
No, just I hope this was interesting enough, at least for people to kind of pique their interest and learn a little bit more about it. Because I think the more people know, the more we can start. We the people, we can take control over. Kind of setting the stage of what's being talked about. So as long as we're ignorant, then they set the stage of what's being talked about, not us.
So what are some books that you kind of just look at as some things to understand monetary policy, how to understand, why economies are the way that they are and how they operate, and what are some books that come to mind? Man,
that's a good one.
So privatized banking, you're talking about that one before. So Carlos Lara and Bob Murphy.
Yeah, I expressed that before. Yeah, that I like it because it talks about a lot with what we teach, but how that's good for you, but also good if everyone starts to implement it. It really could be a profound benefit to society because it takes the pressure off of these things.
Yep. So we talked about that before. So how privatized banking really works by Bob Murphy and Carlos Lara. Another one too, which Peter Schiff has this. It's kind of like because I know Peter and he's such a smart guy and he's very just rock solid on how he thinks things should be and how they are. And really, he's a very intelligent individual. But he wrote a book called Why an Economy Grows and Why It Crashes. And I think that book really just it's very easy to understand. It's on it's as an audio book, but it shows just the nature of economies, specifically free market economies and how they operate, and then what happens to cause crashes, which really is all about government intervention, whether it's stimulating this or stimulating that. So anyway, those are a good one too. Let's see, other books I think would be important. I think just the Fee and the Mises Institute is important, but I also think Paul Krugman. If you go read there's
a lot of articles and columns and blogs and stuff.
Yep. So I read him because he is on the other side of the fence. Okay, really to understand one perspective, I think you have to have the opposing opinion to really truly value what it is and why it's different. And then Bob Murphy and what's his name? They have what's called the Contra Krugman podcast. And so it's the Contra Krugman podcast basically goes through the column that Paul Krugman does, and it's just it's awesome to see their commentary. So that's another good one.
Good.
All right, well we'll go ahead and wrap it up for the week, but thanks for listening, and we'll put a link to the books that we've mentioned on the show notes, so make sure you check those out at thewealthstandard.com. All right, everyone, that's it for this week. Talk to you next week.
Thanks. Bye-bye.
You've been listening to the Wealth Standard Radio Show, your gold standard in everything financial.